Dividend investing is a brain fart. Now, I know thousands of people that like dividend investing. In fact, there's hundreds of blogs dedicated just to dividend investing. And it sounds like such a solid, steady way to invest and get these regular dividends. But I'll tell you, the entire concept is your brain playing tricks on you. It's a brain fart. So what we're going to cover in this dividend is why is dividend investing a brain fart? And we're going to explain why a dividend is exactly the same thing as selling shares, why a reinvested dividend is exactly the same thing as not getting a dividend, why dividends are not income and they're not new money. And then we're going to do some fact checking, logic errors of dividend investors, just show you what the logic errors are. So then talk about what is the difference between a dividend and selling shares, why dividends are a payment frequency, they're just a payment frequency, how we can get, and then how do we get out of this brain fart? How can you perfect dividend investing? And then what are self-made dividends? How to invest effectively for income, or at least something that looks like income? And why are self-made dividends a perfect fit for your life? All right, so let's get started. So dividend investing is a brain fart. So here's my definition of dividend investing. It's the odd belief that taking money out of your investments does not take money out of your investments. I actually kind of like that one. And it's just, if you kind of look at the picture here, if you're selling shares, you're taking money out of one pocket. If you're getting a dividend, you're getting it out of another pocket, but it's exactly the same thing. So let me show you this with an example, because that's the way it'll be clear. So both a dividend and selling shares, they're the same thing, and both of them are just withdrawal from your investments. That's all they are. So now where you see that is on something called the ex-dividend date. Okay, so it's the ex-dividend date is the date when you're legally entitled to the dividend. And what happens is the value of the stock that you own goes down by the amount of the dividend on that day, plus or minus whatever else is happening that day. So what you've basically got is you've just taken a bit of the value of the investment and you just withdrawn it. So dividend equals selling shares, both are withdrawals. Here's an example. So you have a stock worth $10 a share. It's you've got 100 shares. Okay, and let's say you have a 5% dividend for a nice round number. So on the ex-dividend date, the price drops to $9.50 a share. So with the dividend of 5%, you still have your 100 shares. They're worth $9.50 now. So your investment is worth, or $950. Meanwhile, if you sell 5% of the shares, now you have 95 shares instead of 100, but they're still worth $10 and you still have the same $950. So you didn't get any new money, you didn't get any income, you just took money out of your investment. All right, so that example shows it. I'll explain this a bit more yet. So now also reinvesting a dividend is exactly the same thing as not having a dividend. In both cases, you just stay invested. So so if you use the 5% dividend to buy more shares, what happens is instead of 100 shares, you now have 105 shares. They're worth $9.50. So you've got your $1,000 again that you started off with. Okay, but you have to pay tax on the dividend. Now, if let's say there was no dividend at all, and you didn't sell any shares, what happens is you still have your 100 shares. It's still worth $10. It's worth 1,000. You're in exactly the same position, except you didn't pay tax on the dividend. So, you're ahead. You didn't pay any tax, and you're in exactly the same position. So I don't know, a lot of people invest in what is called a dividend reinvestment plan, a DRIP. A dividend reinvestment plan is the same thing as having a growth stock that just grows. The same thing as having a stock with no dividend. It's exactly the same thing, except that you have to pay tax all the time. Now, let's look at these logic errors, and this is where you really see it's a brain fart. Actually, I kind of find this, a lot of fun to look at. So first of all, the first logic, these are six things that dividend investors believe that are false. So first of all, dividends are income and they're new money to you that the company is sending to you. But okay, that's false. We saw in that last example, it's really money from your investments that the company is sending to you. It's actually forcing you, to take money out of your investments and sending it to you. So second one is you're receiving income. So you still have your shares and you're getting this dividend, which is income. You still got your principal, and that whole concept is false too. So first of all, there's no such thing as principal with equity investing. Your investments fluctuate in value, but there isn't a principal and an interest. There's just a value of the investment. Okay. And so a dividend, you're withdrawing from the investments. So that's all. It's just it's you're withdrawing some cash from the investment. It's not income. It's not new money. It's just taking a bit of the investment and withdrawing it. Now, another dividend investors also think not selling during a correction and a bear market. So the markets are down. I'm not selling. Because I'm still getting my dividend, right? But I don't sell the shares. So that's a plus. But that's completely false because you are selling. A dividend is the same thing as selling investments. And they say that reinvesting the dividend is buying low, right? And it's dollar cost averaging. If you get a regular dividend, say every 3 months, and you always reinvest, you're buying more new shares when it's low. So you think you're buying low that way. But again, completely false because the reinvested dividend is both a withdrawal and a new investment. So you're taking money out of the investments and putting it right back in. You're not buying low. You're in exactly the same position as where you started. So now dividend compounding, if you reinvest the dividend, right? So my stock is growing and I'm getting this new cash from the dividends and I'm reinvesting it. So again, that's another thing that dividend investors think. It's completely false. Reinvesting dividends isn't new money. It's a withdrawal from your investment, right? And then so a reinvested dividend is the same thing as no dividend. So there's no compounding from reinvesting the dividend. All it means is you're leaving money invested. This next one is actually interesting because the thought is, you're living off your investments, they're saying, well, dividends are forever because you always have the stock and always pay a dividend. But if you sell shares, you're eventually going to run out of shares, right? And again, that's completely false, but you have to think about this for a minute. And the reason it's false is, so if there was no dividend and it's the same company, what happens is the share value would grow and grow and grow and grow, and you could still sell shares of it. So bottom line is you can sell 5% of the shares exactly as long as you can take a 5% dividend. So basically forever. So there's no difference between them. I know that one takes a little bit of thinking because you're thinking, oh, I'm always selling shares. Don't I eventually run out? And you don't, because if it grew constantly, you'd be taking a smaller and smaller number of shares to get the same constant dividend value. All right. So bottom line, remember, dividends are a withdrawal from your investments. They're not income or new money or anything like that. Now, so what is the difference between selling shares and dividend? The difference is the tax and who decides. Okay, so if you look at a dividend, the value of your investments, dividend, it goes down by 1,000, and if you sell shares, it goes down by 1,000. The value of your investments. You look at the cash that you have on hand. With a dividend, it goes up by 1,000, and selling shares, it goes up by 1,000. Okay, so you're in the same position. Now, what's the difference? With the dividend, you're taxed now, and you're taxed based on the dividend tax. Okay, versus if you're selling shares, you're only paying it's a mixture of tax-free capital gain. So part of it is your original money that you invested, and part is the capital gain, depending on how much the stock has grown up until now, right? And you defer the tax until you actually sell. So people often look at what's the tax rate on a capital gain versus tax rate on dividend, but that's actually not the comparison. Because when you're selling, a big amount of it is the amount that you originally paid. So you're only paying a capital gain on the growth part. And that's why the tax is lower when you sell shares versus on a dividend. The other big difference is who decides. And with a dividend, it's the company they decide. They decide how much the dividend to pay is, how often to send it to you, and they control all that stuff. They're forcing you to take this, and you're forcing you to pay tax on it. While if you're selling shares, it's entirely up to you. You can not sell or sell as much or as little as you want anytime you want. So you have full control. So a dividend is taxable income forced onto you. That's really what a dividend is. So it's funny when I read these dividend bloggers, they're always, kind of bragging about, oh, how much my dividends are up to 5,000 or 10,000 a year, like they're growing steadily. And I always feel like what I hear them saying, well, that's too bad, because these guys are saving up for the retirement. So they don't need any income, right? This is on top of all their other income. They're paying tax on it and they don't need it. So I keep saying, well, it's too bad that you have to pay all this tax when you don't need it. Anyway, now dividends, what they actually are is a payment frequency. And think of it this way. Now, with a dividend, the company decides how much of your investments to sell and send you. It's usually quarterly. Now, so dividends versus no dividends is like a quarterly pay GIC versus a compound GIC. So, guaranteed income certificates, if you ever bought them, what happens is you can buy some that pay their interest monthly, some quarterly, some annually, and some pay on maturity. Okay, so if you get a quarterly pay GIC, that's kind of a lot like what a dividend is. It's the investment automatically sends you money every 3 months. So it's the payment frequency. While having a growth stock or a stock that doesn't pay a dividend is like having a GIC that pays on maturity only. So basically you're deferring the tax all the way until the end, until you sell it. So question is, what payment frequency do you want? Now, how do you get out of this brain fart? Because it's so easy to think of the dividend is income. It's so easy to get sucked back into this weird brain fart. And the way to do it is you always focus on the value of your investment and not the dividend. So don't look at how many shares you have. Don't look at the price per share. Just look at the value of the investment. So it doesn't matter if you have 105 shares or 100, or the price is $9.50 per share or $10. In both cases, you have $1,000 of investment. So just think of that. When you get a dividend, oh, I took a bit of money out of the investment. I reinvest the dividend. I put the money back into the investment. Just think of it that way, as the value of the investment. And that way you can kind of train your brain to think about it, clearly. So remember, a dividend is a cash withdrawal. How should you look at dividends? So the way to look at it is like Warren Buffett is, be agnostic about dividends. So, I can say with my own personal investments, I am unaware of what the dividend payout is. I don't care what it is. I hope it's low, but basically it's, dividends are amount you have to pay tax on. I don't need the tax. I don't need the income at the moment. It doesn't matter. And I just automatically reinvest all the dividends anyway. So it doesn't matter. So dividends are not one of the top 20 criteria for choosing the best stocks. The best stocks are based on how fast they're growing their profits and how reliable it is and how safe they are, how much moat, as Warren Buffett calls it, like how easy is it for other companies to take their business, and basically how reliable is the long-term growth of the company, and how high and how fast is it growing. So those are the main criteria for it. It's not whether or not it pays a dividend. And your universe when you're investing should be 100% of stocks globally, should be anywhere. You shouldn't restrict your investing just to Canadian dividend stocks. Canadian stocks are 3% of the world's stocks, and now you're going to restrict yourself to only stocks in Canada that also pay dividends. So you're limiting your entire universe of investing. Dividend investing, how do you perfect it? Self-made dividends. I've done a couple talks on this before, but I'm just going to talk about this briefly. It's dividend investing perfected. So you get all the advantages of dividends, every single one, and you avoid all the disadvantages, every single one. So it's just a perfect way to forget about ordinary dividends and have self-made dividends. So first of all, what are self-made dividends? It basically is all it is, you sell a bit of your investments. Usually it can be every month, or if you're retired, that's usually what you do. You set up to automatically sell a bit of your investments each month, or however often you want to have it. And so that's all it is. You're just selling a bit of investments. Self-made dividend sounds complicated, but it's not. You're just selling a bit of your investments each month. You choose the amount. It can be automated with some types of investments like mutual funds, or we work with these portfolio managers, and it can be automated. You only withdraw when you need the cash. So while you're saving for your retirement, you don't take anything out. You just leave it all to grow. As soon as you need the income, then you start income. You get it monthly. It shows up in your bank account, the exact amount that you want on the first of every month, and you have complete control of it. And it's very tax efficient, less tax than you would with ordinary dividends. So the key point here is you need cash flow, not income, like after you retired. So, income is taxable cash flow. You want to kind of control the cash flow that you get, and therefore the tax on it. So how do you effectively invest for income? I call it income with quotes, but basically it's for cash flow. So here's how you do it. 4 steps. First is invest just in equities based on the maximum reliable long-term return. So basically you're just trying to find good stocks or a good method of investing in stocks. So we use these portfolio managers that are trying to find an all-star team of the world's best investors. But whatever your investment is, you're trying to invest effectively in the best stocks, and then basically completely ignore all the dividends, reinvest them all, just ignore them all, because they actually mess up your cash flow. It's hard to control how much money you're getting if you're also getting dividends, because they're not even and you don't control it. So then what you do is you take self-made dividends, you sell a bit of your investment only when you need the cash flow. So, all right. So if you need it sometime, you take some money out, but usually you let it grow till you retire. Then you set up an automatic monthly amount that comes to you. So you need cash flow, not income. Income is taxable cash flow. So when you're saving for retirement, it's what they call it, the accumulation phase. Then you should set your self-made dividends to zero. Just let the investments grow. Okay, so zero cash flow needed from your investments, and avoid all the tax on dividends. So if you were getting dividends, you'd be paying tax on all those amounts while you're saving up. But here, you're not paying tax on anything. You're just deferring it all till much later when you sell it. Then when you actually retire, you start your self-made dividends for a sustainable withdrawal amount to provide the retirement lifestyle you want. So you decide how much income or how much cash flow you want for your lifestyle. You make sure it's a sustainable long-term amount. So this phase of your life when you retire is called decumulation, and it's because you're slowly taking money out. So you probably invest the same as accumulation, because you or your spouse, at least one of you, is likely to live at least 30 years from when you retire. So it's very, retirement is a long-term thing for almost everybody. So, and I've done a few talks on what's called the 4% rule. So this is, if you're looking for a sustainable amount, this is generally sustainable 97% of the time through the last 150 years with no management, and 100% if you know how to manage the withdrawal rate. So that's, so you take, let's say you retire, you take 4% of your investments and you set it up to automatically send it to you each month. And then every year you just increase it by inflation. And that's how you do it. And it's been completely reliable if you have, between 70 and 100% equities. Generally 100% equities is the safest long way to invest long term. It's the most reliable over a 30-year retirement, where you're looking for a rising income through retirement. So what I can tell you, stocks are, up and down a lot short term, even medium term, but they're much more reliable than you will think long term. And, compared to other investments like bonds will get killed if you get a period of high inflation in there somewhere, but stocks tend to adjust for it. Now, so based on my previous studies, if you're a bond investor, you can only take about 2.5% of your investments out a year, but equity investor, you can take 4% out a year. So it's a fair amount more. Out of a $1 million portfolio, you could take 40,000 a year instead of 25,000. Plus the 40,000, you pay less tax than the bond investor would be on the 25,000. So basically, those are the 4 steps. And the whole idea of self-made dividends is a perfect fit for your life, because you're adjusting that. You're not being forced to take money when you don't want it. You take nothing while you're saving up, let it all grow, and then when you start taking it out, you take the exact amount you want, the exact frequency you want. It's just a perfect fit for your life. So so self-made dividends are better than ordinary dividends in every way. So you get better returns because you can invest for risk and return, not just dividend stocks. You can diversify globally, not just in Canada. You have complete control of the timing, frequency, and the amount that you get. You pay lower tax because part of it's your own is tax-free capital, and parts of the capital gain you defer the tax until you sell, not while you're saving up. So, deferred, I have a video about this. The deferred capital gains is the lowest taxed type of investment income. And you get lower clawbacks of government benefits after you retire, because dividends are actually, the dividend tax is a weird formula where it's grossed up, so you get $1,000 dividends, actually shows that 1,380 is taxable income, and you lose more taxable benefits based on it from the government. So cash flow only when you need it. You're not forced to pay tax when you don't need it, like when you're saving up. And, it provides cash flow, not income. Income is taxable cash flow. So you see, self-made dividends are better than ordinary dividends in every way. And they don't have the brain fart. All right, so thanks for listening. So these are all the things we talked about today. So now you know why dividend investing is a brain fart. You understand that dividend is exactly the same thing as selling shares. Reinvesting a dividend is exactly the same as not getting a dividend. And you understand why dividends are not new money or not income. Fact checking, we went through all the logic errors, the brain fart of dividend investors. So you know the difference between dividends and selling shares. You know the dividends are just a payment frequency, and you know how to get out of the brain fart by focusing on the investment value. You know how to perfect dividend investing with self-made dividends, and how to invest effectively for income, and why self-made dividends are a perfect fit for your life. So now you understand all that. So, all right. So my name again is Ed Rempel. My blog is called Unconventional Wisdom. It's just edrempel.com, or it's even unconventionalwisdom.ca. It has to be .ca, not .com, because .com some scam site. .ca because we're in Canada. If you want to talk to us about potentially working with us, just go to edrempel.com/talk. I also have a podcast and a YouTube. Podcast is edrempel.com/listen, and YouTube is edrempel.com/watch. Thanks again for listening, and we'll see you next week.